All right, Bulls and Bears, we have more consolidation in the financial industry. We now have Capital One Credit Card Company buying Discover Credit Card Company. And this is what I said would likely happen: more consolidation, more integrating banks together. And we typically see this really increase and consolidation really increase when there's a lot of negative things happening, a lot of delinquencies, defaults. Of course, we saw the bank runs and the bank failures back in March of last year. And from that, we did see many banks get bought up by much larger institutions. In this case, we have Capital One buying Discover. So, what's the reason? Well, let's go ahead and get into it here. And I want to bring you to a chart here that shows the defaults and how they've really dramatically increased over the past few years. This is both Discover and Capital One net charge-off ratio. We saw it was just above 1% in September 2021. That was the low. That's when the stimulus checks started basically getting spent, or they had been spent by that time for the most part. We saw the charge-offs increase. If you look at the red line, that's Capital One, up to over 5.5, close to 6%. And Discover Financial actually a little bit under that, about 5 and maybe 1/4% charge-offs, but both big increases from just over 1% that we saw just a couple years ago. All right, so what's going on here? Why would this be happening right now? Well, this is, I think, the name of the game. I think the name of the game is to consolidate the financial industry. And I think before this is done, we're going to see a lot more banks get bought up, banks fail, and then, of course, a big bank comes and buys out their assets, basically. And that way, when it comes to propping up the financial institutions, the less institutions there are, if a whole bunch of buyouts happen, then you don't have as many to prop up. You only need to prop up the biggest, let's say, 5 or 10 banks in order to prop up the whole system. That way, you don't have to send out, all this rescue money to thousands of different, tens of thousands of different banks. It's going to be just a few mega banks that they'll prop up, again, in order to keep on buying up the assets of these smaller failed institutions. Not that Discover was small, they're one of the biggest credit card companies out there. But it's interesting when you see the defaults happen that you see these consolidation measures really ramp up. Now, we're going to get more into the details behind this Capital One buyout of Discover, and we're going to have a lot of other good news on the other side. But first, a quick word from our sponsor. All right, folks, let's talk about protecting your wealth. The world is crazy right now, and it's time to think beyond the usual investment paths. Consider diversifying your portfolio. Let's talk about integrating precious metals into your 401k IRAs and savings. Why precious metals? The reason is clear and compelling. In the face of market volatility and economic uncertainty, gold and silver have consistently proven their net worth. They aren't just assets, they're your financial safeguard. Adding precious metals to your investment mix brings that balance, offering a hedge against inflation and currency fluctuations. My friends over at American Alternative Assets are here to help you navigate through the entire process. With their expertise, converting part of your 401k, IRAs, and savings into precious metals is straightforward and secure. There's a lot of unknowns, but this is a timeless way to fortify your future. You want to learn more? Download their free 2024 Wealth Protection Guide below. I've been saying it for a while. Things are getting bad and likely seem to be only getting worse. Make the move into gold. It's a decision that positions your portfolio to weather the market's volatility. With precious metals, you're not just investing, you're taking control. Visit the link below. With precious metals, you're not just investing, you're preparing for whatever comes next. Act today. All right, so here's some more over on this here. This was widely reported, by the way. Under the terms of the deal announced Monday evening, Discover Financial Services shareholders will receive a little over 1 share of Capital One for every Discover share they own. That represents about a 27% increase from Discover's closing share price of $110.49 on Friday. If the deal is finalized, it's not final yet, but it's looking like it's going to be. Current Capital One shareholders will own about 60% stake in the combined company, while Discover shareholders will own the remaining 40%. And the deal may take up to a year to fully close. Now, Discover, they're actually a smaller company than their competitors, Visa, MasterCard, and American Express. But think about this: when you have less competition, is it better or is it worse, right? So when you have more choices, you have a little more competition, right? So you can't just raise your interest rate to 30% if the other three card companies are down to what, 22%. What's the typical rate now? About 22, 23%. So they can't do that. They have to stay somewhat competitive. But now the fewer the card companies there are, you're not going to see as much competition. So it's going to be even easier for these companies to raise their interest rates even higher and to not offer as many rewards, not offer as many incentives, uh, maybe even increase their late fees and their over the limit fees. Who knows? But in general, we do know that less competition is not good from a consumer standpoint. Now, of course, if you're in the stock or if you work for the company, then of course this is great news because you're going to have much more leverage now over the U.S. consumer. And folks, the more leverage institutions have, the more they're going to basically abuse you. Listen to this. Americans' savings rate shame. Three biggest U.S. banks last year raked in $200 billion, mainly on the back of higher fees and higher interest rates, but only pay out a fraction of a percent to people saving their money in these institutions. Is your bank ripping you off? That's what the article says here. This is out of the UK here. Wells Fargo, Bank of America, and JP Morgan made $200 billion. Just the three biggest banks, $200 billion. Um, all three banks offer just a fraction of a percent on their savings account. Folks, this is all going back to the source or the system of our money, right? If banks couldn't just loan this money out without actually having it, they would be forced to offer a higher rate for your money to be deposited in their institution. This is the whole problem when you have money that's not attached to something hard like precious metals, gold, and silver. If it were, banks wouldn't be able to loan out money because they'd have to actually have the physical money in possession to be able to loan it out. So then they'd have a big problem. They would have to entice you, incentivize you to put money in the institution. So, of course, banks don't want that. They don't want sound money. They don't want hard assets. And that's why we're going to continue to see inflation explode because they're going to continue to throw money at the problem, not just the banks, the government. Are going to continue to create more money and try to gloss over all the shortcomings and downfalls and pitfalls that we see in the economy right now. But it doesn't go without consequences. I think we're going to see inflation really start to take off even more here in 2024. And I think that's what the quote unquote leaders would like versus deflation. Deflation, everybody sees what's happening when deflation occurs because you have massive job losses. You have overnight sometimes or in a matter of weeks, you have markets correct 10, 20, 30, 40, 50%. Just look at 2008, look at 2020 with the stock market. The leaders, they don't want that to happen because that's way too obvious. When there's inflation, it's more of a slow bleed type of scenario or a frog in the pot scenario where people don't fully realize what's happening until they look at the data and compare it to a couple of years ago. Then they see, wow, look at how much prices went up. But from day to day, it's not really that noticeable. So I think that's what's going to happen unless we see something big, something huge come in and knock the legs out of this whole system, which would be something so big that we can't even probably think of something that big that would do that. But it's out there. Things like that could happen. Will it happen in 2024? I think so. I think we won't get out of this year without something major dropping, so to speak. All right. So everybody, let me know what you think about this consolidation with the credit card companies, Capital One. Very likely to be buying out Discovery Card. Is it good? Is it bad? You let me know what you think about this, the consolidation in general in the financial sector. Keep stacking, everybody. We'll talk to you very soon. Please like, subscribe if you like what we talk about, and come back for more economic financial news. Stay free. Keep stacking, everybody. Bye for now.